doing great here in the business and producing a lot of cash flow for yourself so that you can ultimately have this full family bank, you guys are literally going to set yourselves up for the rest of your life. And not only is it you and your kids, but your grandkids. I want you to think about that. Your grandkids, people that you probably will never meet in this life are going to be affected by the decisions and the plans that you can put in place today. So I want to let you know the power that you have in front of you, right? And I'm going to teach you how this works, how I understand it, how I've explained it to people. I don't want to get too technical, right? It's very easy to get in the weeds with this stuff, but I'm going to keep it high level because we're a marketing company. And I just want you to know how to market this program. I want you to know how to market infinite banking and family banking and explain this to people. And if you do this correctly, let me tell you, you might be able to help people save $100 a month or $50 a month or $250 a month, but your average deal is going to go from like $200-300 a month to $2,000 to $3,000 a month, right? And I want you to imagine, what if your average deal went all of a sudden the second half of the year to $2,000 to $3,000 a month, right? People wanting to put $100,000 in up front. People wanting to put $250,000 in to their family bank up front. What would that do for your cash flow, right? We're all running for Hawaii right now. We're all running for our next promotions right now. We're all running for our next milestones right now. We're all running for EC. We got to get 75 million points as a pinnacle hierarchy to get Eric and Sandra to EC. And if we can all come together and understand this and actually get out and be passionate about it when you explain it and just be, believe in it yourself, invest in this yourself, right? Because the best way to be convincing is when you're convinced, when you're convicted, right? They say when you believe, you will be believed, right? And I'm going to show you some of the things that I've put in place here so right, I'm backing up what I talk about. So without further ado, let's go ahead and get into it today. Are you guys excited? I'm excited. All right, get your pens and paper ready. This is my phone number right here. This is my little Instagram right here. So you guys can go ahead and, follow me on that or reach out with any questions and I'll be happy to get back to you guys as soon as possible. So because we're in a marketing company, I want to make sure you understand marketing terminology. Now, what really is marketing, okay? Marketing is the process of you sending out a message and that message being received by others. Okay, marketing is the process of you sending out a message and that messaging being received by others. Okay, I went to school for a business degree with a concentration in marketing and a minor in psych. And who knew that I would end up in a business that's exactly what I needed to know to be very, very successful here. Because as much as we think sometimes we're in the financial services business or financial planning business, you know what business we're really in? We're really in the people business. We're in the people business. And you got to understand people. See, products change, concepts change, but people never change. So if you can get very, very good at people, you're going to be very, very successful here with us. So getting back to the marketing side of things, there's a couple great books and terminologies out there, and I want you to just take them for what they're worth. Take the good, leave the bad. That's like with field training or your leadership or any training that you hear or any book that you read, really. Everything's not going to be 100% in alignment maybe with what we do, but I want you to take the good and leave the bad. Even in what would the Rockefellers do? They're not necessarily talking about IULs because that wasn't around when the Rockefellers were around. So they're talking about what they used to use when the Rockefellers were around. But obviously, we have the latest and greatest, the iPhone 11X version, right, of what the Rockefellers were able to use. And I'm pretty sure if they were able to use what we have our hands on now, they would be using it. Okay? So I just want you to take that with a grain of salt. There's a guy, Doug Andrew, out there. He has a bunch of videos, 20 new videos or something like that. He actually speaks highly of IUL. He talks about how it works and how you can leverage it. And some of those concepts I'm going to be going over with you guys today. But even for that, those videos are fantastic for ourselves. They're great for us as agents and financial professionals to learn and grow and increase our knowledge base and our belief and our conviction level, right? But I wouldn't really be sending that out to, all your clients and your entire team and things like that. Right? But use it for yourself, use it for your own knowledge so that you can be more competent and confident when you're speaking to other people. Okay? So he has a book out called The Laser Fund. the laser fund. So once again, we're talking about marketing terminology. So you call it IUL, he calls it the laser fund. Which one sounds sexier? Right? The laser fund. What's that? I just think about Austin Powers sharks with freaking laser beams on their heads, right? That's what I think about when I think of laser fund. But laser actually stands for liquid assets safely earning returns. Liquid assets safely earning returns. Okay, so think about that. It's marketing, guys. It's marketing. Okay, there's another one, right? Garrett Gunderson, who wrote the book, What Would the Rockefellers Do? Right? He calls, right, permanent life insurance policy like this that you can use to fund your family bank. He calls it cash flow insurance. And we're going to talk about why he calls it cash flow insurance later. But he also uses two terms during that book. He calls it a bullet fund or a war chest. And so I want to let you know, a bullet fund is basically something that you would have in reserve to take advantage of an opportunity. You know, oftentimes, if you've ever heard Eric share the 3 circles presentation with the perks, and we talk about E being for emergency fund, right? But it's not just emergencies, it's for opportunities, right? It's to further yourself along. It's to further your family. It's to get out of debt. It's to reinvest. It's to build wealth, build net worth, right? And so that's what a bullet fund is. It's having money saved up to take advantage of an opportunity, right? And Eric's obviously been able to do that quite a few times in his career. There's also something called a war chest. A war chest is more like an emergency fund. That's when you need to go to war and you need some reserves behind you to get you through this wartime period. Okay, I think about what's going on right now with the coronavirus and the shutdowns and layoffs and furloughs and all this stuff happening right now. How many people wish they had an extra 50 or 100 grand in their war chest right now? Right? I mean, they would just feel so much more comfortable. They'd be able to sleep better at night. They'd be able to know that their family can weather this storm, right? And, God bless that we've been in a position, to be able to do that for our own family. Patrick Kelly has a great book out there called Tax-Free Retirement. And one of the reasons I love that book is because it's almost like case studies, right? The last 4 chapters or so are like case studies, like why do kids and grandkids need a tax-free retirement? Why do business owners need a tax-free retirement, right? What's going on right now with all the small medium businesses shutting down? Why do, healthcare professionals, doctors, nurses need a tax-free retirement? Why do high income earners need a tax-free retirement? Shoot, why does everyone else need a tax-free retirement? And he talks about that in there. David McKnight has another book out there called The Volatility Shield. So once again, you call it Index Universal Life. He calls it the Volatility Shield. What sounds sexier, right? Wouldn't it sound great? Like, think about that. That sounds like you're going to war. I have a volatility shield, right? Anything that goes up and down doesn't matter. I got the shield for it, man. I'm protected. So I want you guys to just remember, you're in the people business. You're in the marketing business. You got to understand the message you're putting out and how that message is being received. Okay, we spoke about this a little earlier, but this is the book right here that was the inspiration for this whole talk, this whole plan, everything me and my family have already set up. By the way, we already had about 6 IUL plans in place, and we just added another 7. So we're at 13 plans, 13 IUL plans to create our aggregate family bank, right? And we have about $250,000 saved up in there. That's besides the hundreds of thousands of dollars elsewhere we have liquid, right? So I just want to let you know something that Rich Tholley always talks about and always preaches, which is make more, save more, and spend less. Let me say that again. Make more, save more, and spend less. We were just on a mentorship call with Rich Tholley just yesterday, and he talked about being a safe money millionaire. A safe money millionaire. And what does that mean? That means having $1 million liquid and conservative saved up. Don't you think you can weather any storm if you had $1 million liquid and conservatively saved up? Of course. And that's what we're talking about here for you. That's what we want for you. Okay. So very exciting stuff. Let's get into it here. Couple things from this book. Okay. One of the things he says is eliminate destructive expenses. And once again, one of the things that I've been teaching my team, because oftentimes when people come into this business, they think, oh my gosh, can you sit with them? They make a lot of money. I'm like, wow, how much do they make? They're like $200,000, right? Like they're freaking out. And that's probably an identity issue. Okay. Or maybe the fact that they've never made 200,000. But 200,000 is not a lot of money. Can we just be honest? Okay, if you're making 200,000 in California, you're like scraping by, right? That's basically it. Okay, so that is not a lot of money. All right, a lot of money is relative. A lot is relative. So it just means it's a lot to you. It doesn't mean that it's a lot in general. It just means it's a lot compared to you, right? Compared to what? And so one of the things that I've been teaching my team, maybe you can benefit in this too, to help with their identity is do not be impressed with how much money people make, but be impressed with how much money people keep. Let me say that again. Do not be impressed with how much money people make, but be impressed with how much money people keep. Okay, that's what's impressive to me. You show me how much money you have saved. You show me your investments and strategies and things. Okay, I'll be impressed with that. But I know doctors and lawyers and business owners that I've sat with in my 6 years that made $400,000, $500,000, $600,000 and they're broke. They're paycheck to paycheck. It's ridiculous, right? It's irresponsible. What are they passing on? Nothing. Okay, so do not be impressed with how much money people make, but be impressed with how much money people keep. And one of the things that this book talks about is eliminating destructive expenses. Okay, and so what are destructive expenses to us? Well, number one, vices and weaknesses. Okay, everyone has their own. We don't need to get into all the topics, but some of them cost money. They're not good for you. They don't help you short term. They don't help you long term. They're not good for society. Get rid of them. Okay, get rid of them. Quit wasting your money on that stuff, right? It cracks me up when, people, and I hate to say this, but younger people, right? They're at the club making it rain, because they just got a cycle. And, us responsible people are just putting that money away, reinvesting that money, finding how do I grow it? How do I multiply this, right? And they're thinking, how do I waste it? Shoot, might as well just light it all on fire. I mean, that's what you're doing. Okay, so vices or weaknesses gotta go. If you want to be debt-free, if you want to have financial independence. If you don't, no problem. Keep doing what you're doing. Next one would be overdraft fees or like excessive loan fees, things like that. So how silly is it? It's very easy to keep a budget, but most people, they can't even take place in this stuff. They're getting charged with overdraft fees and all that stuff, right? Probably the only good overdraft fee was the one Eric Olson suffered in putting his $100 down for his AMA so he could build 50 million of net worth. Okay, that's probably the only overdraft fee that would be acceptable at this point. But for the rest of us, right? No, right? You got to get your money right. You got to eliminate that kind of stuff. See, this either the system takes advantage of you or you take advantage of the system. Which one do you want to do? And we're going to teach you the latter. Another one is taxes. Guys, we're business owners. Okay, if you're not writing off a portion of your electricity, right, all your internet, your cell phone, the computer you're using to watch this on right now, any upgrades you've done to your home office since this whole shutdown, if you're not keeping track of that stuff and writing it off, you're missing the boat. You're a business owner. You get write-offs. We're not employees anymore, right? The companies don't get all the write-offs and we're an expense for them, right? You're the business owner. Don't you know how that works? W-2, make your paycheck, do all of your taxes first, then you get to spend what's left over, so government gets first dibs. Or business owner, you do all the spending first, and then you only pay taxes on what's left. Shoot, I'd rather have that one. You want first dibs or the government want first dibs? It's up to you. Right? But get your money right. Learn about this stuff. Study it. Get a good CPA. Guys, we don't want you to just be good in business. We want you to be good in life. That's why we're teaching you this stuff. Last thing would be loan payments. Okay, so any sort of loan payments, right, where you need to look and see, are these good loans, bad loans? What's the deal? Okay, so these things I want to walk you through right now with this cash flow index. Okay, cash flow index. So get out your calculators real quick, follow along with me on this cash flow index because I want to teach you how to assess if a loan or a debt is going to be good debt or bad debt. Okay, let's talk about this for a second. I think this is pretty important, right? This is one of the big things I want to make sure you guys understand because I think it'll help you in life, all right? So let's say you're buying a $30,000 car. You finance that, and it's $600 a month is your car payment. So all you would do is you would take the loan, $30,000, okay? You would divide by $600 a month, and that's going to give you a score of 50. 50. Where does 50 fall in this cash flow index? Well, it falls right in the middle of danger zone and watch out zone, right? So that is not good debt. You understand? Not good debt. Okay. Let's take a mortgage, for example. Let's say you have a $500,000 mortgage. Okay. I don't know where you get that around here in California, but let's just say you have a $500,000 mortgage and you divide by, let's just say it's 2,600. Okay. 2,600 a month mortgage payment. Well, you're going to be at 192. So where does 192 stand on the cash flow index? Well, you're in the freedom zone. So that's good debt. So do you guys understand this? I want to make sure you're getting this. If ever you're looking at a situation where you need to finance, or frankly, you're already financing, you need to assess yourself on these loans. You need to get rid of anything in the watch out zone or danger zone as quickly as possible. Like, throw your money there and get that stuff off your plate. Okay? If you have some freedom zone type of loans, cash flow index, good debt, that's okay. That's okay. All right? But anything under 100, no bueno. No bueno. You guys got it? So here's what I want you to remember about destructive expenses. They have negative effects on your life, or it's anything that pushes you towards poverty and debt. They have negative effects on your life, and it's anything that pushes you towards poverty or debt. Cash flow insurance. This is what Garrett Gunderson refers to as family banking. Number 3 things it does. Number 1, safeguards your wealth. Do IULs safeguard your wealth? Yes. Number 2, helps you grow your money and increase your cash flow. Do IULs help you do that? Yes. Number 3, helps you enjoy your money today and tomorrow. Today and tomorrow. See, a lot of us just talk about IULs being used in the future. Oh, this is what you got to do. You got to save now so that 20, 30 years from now, right, you're going to be able to use this money. Well, shoot, what about now? Last time I checked, we live in an instant gratification society. Like, what about, like, what's in it for me now, though? Right? Family banking teaches you how to use your money today and tomorrow. Very powerful. Here's what I wanted to teach you about financial institutions, the banking institutions. Okay? Couple things. Number 1, they want your money. We know that. They want our money. They want our money on a regular basis. Think about direct deposits. Hey, if you're succeeding here, it's every Tuesday, every Friday, every Tuesday, every Friday, right? Or if you have a W-2 job, maybe it's every 2 weeks, or the 15th and the 31st, or whatever the case may be. But they do want our money regularly. They want to hold on to that money for as long as possible. And then when it comes time to pay us that money back, they want to do that as slowly as possible. So the banking institutions understand how all this stuff works. They understand the rule of 72 better than anybody else out there in the world. And they understand how to work all of these things in their favor. See, after today, I want you to know how to work these things in your favor, in your family's favor, and you to be a resource to other people to show them how that works in their favor. Stop being taken advantage of and start taking advantage. How the banks really work. Let's go over this. I wanted to title this How the Banks Screw You, but Eric said keep it PC or PG, right? I said, okay, I'll do that. So how the banks really work, okay? You're a client at the bank. You walk your money to the bank every 2 weeks. Let's just use an employee example. Okay, you walk your money to the bank every 2 weeks for direct deposit. You put it in the bank. It's backed up by the FDIC, which backs you up to $250,000 per institution, not per account, per institution. And you have a nice, warm, fuzzy security blanket because you think, oh, wow, the FDIC, they got my back, right? Well, they do, but they have 10 years to pay you back if that financial institution goes under. And it's per institution, not per account. So you should not ever have over $250,000 at a financial institution, because they're not going to back you up for more than that. Okay? So what does FDIC stand for? It stands for Federal Deposit Insurance Corporation, which is an insurance corporation backing up the bank's money like this. Now, I joke around and say that it probably should stand for Funds Don't Increase Correctly, because you're not really earning anything at the bank, are you? Probably closer to 0 than 1. And if you make over $10, well, guess who wants a piece? The government. So, yay, I made over 10 bucks in my bank. And the government goes, can I have a few of those dollars, please? Right? I mean, that's the way it works. Getting dibs on your money. It appears that we're the last to get the benefit. That's just what I see. Okay. Now, what are the banks doing? They're not really wrapping up your money in a nice little red bow, setting it up on a shelf and saying, oh, let's just wait for so-and-so to come back, right? And then they can get their money. No, right? They're making money on your money. Making money on your money. They're doing it two major ways. Number one, they're lending it out. You know, you've heard of banks called savings and lending institutions. I like to say we save, they lend. Are you with me? We save, they lend. Okay. So they're lending out our money to other people to capitalize on the Rule of 72 and compound interest to work in their favor. So they're doing this through mortgages, auto loans, business loans, personal loans, credit cards. What are credit cards charging people today? Well, about 16 to 24%. Would you agree? So the banks understand they're doubling their money about every 3 years. Every 3 years. And the reason they do this is through something called 1-to-10 ratio, fractional reserve lending. We don't need to get into specifics. You can look it up on Investopedia. But totally legal. For every $1 million that we have in the bank, they can lend out up to 10 times that amount. Do you guys remember back in 2015? I remember this image in my head. It's still burned in there today. Greece was going bankrupt. And a bunch of people were standing in the line at the bank, just lined up at the bank, trying to get their money out of the banking institutions while the whole country was going bankrupt. And you know what the banks did? They shut down. They shut down. We don't have the money. Sorry, go home. We don't have it. Did you know that if all of us did the same thing, we all went to the bank right now and said, all right, give me my money. You know what they're going to tell us? We don't have it. We don't have it. Why? Because of that 1-to-10 ratio. Totally legal, by the way. What a scam. What a house of cards. Look at what got us into that issue in 2008, 2009, guys. Wise up. You're being used. So guess what the banks do with their money? They put it in a place where they held an opposite ratio, 10-to-1. So for every $10 million insurance corporations have, they can only lend out one. Why? Because they're held to different regulatory and reserve standards, which makes insurance companies 10 times as safe as the bank. So it always cracks me up when people say, well, is this FDIC insured? I go, this is the people that are at the FDIC. What are you talking about? This is where the banks are putting your money. And you're worried about if there's FDIC? Oh my goodness. All right, take a deep breath. Okay, woosah. So the banks are earning 6 to 12% rates of return, but the real kicker is they're growing and accessing this money 100% tax-free through a couple programs called BOLI and COLI. I want to show you this. There's another book out there, very easy read, it's like 60 pages, called Money Wealth Life Insurance, where it says how the wealthy use life insurance as a tax-free personal bank to supercharge their savings. And in this book, it talks all about what I'm showing you with the banks right now. And down here in the second paragraph, it says cash value life insurance plays a massive role in financial institutions, corporations, and banks. More than you could ever imagine, these organizations buy life insurance by the billions and use it for many different reasons. Not only does it increase their financial stability and reduce their taxes, it's an ideal place to fund employee pensions, healthcare costs, and other benefits. It's so common among banks and corporations, they even gave it its own name, bank-owned life insurance, corporate-owned life insurance. Okay, think about that for a second. These are the top 4 banks in the US, guys. And Bank of America is putting almost $20 billion into life insurance. Wells Fargo is putting $18 billion into life insurance. Chase Bank's putting $10 billion. US Bank, $5.5 billion. Billions and billions and billions of dollars. And the question I have for you is, when are these banks going to die? When are these banks going to die? And you're looking at me, Austin, banks don't die. That's correct. Why do they need life insurance then? Because they're not using it for the death benefit. They're using it for all the tax advantages it provides. So look down here in the second paragraph. It says, for banks, it provides the ultimate in safety, stability, and growth. And more importantly, the FDIC allows this asset to be classified as Tier 1 capital, which is the safest capital a bank can have. So let me ask you a question. If this is the safest capital a bank can have, imagine what it did for you and your family situation. And you're worried about if it's FDIC backed up. Come on now. Come on now. Fortune 1000 companies, 68% of them use the same strategy for executive retirement plans. Okay? It says its ability to provide the stable growth necessary to create a predictable income is one of its most powerful features. Let me ask you a question. In a retirement plan, are stable growth and predictable income two features you would want in a retirement plan? Yes or yes? Of course. So look at what all these companies are doing. By the way, are these like little mom and pop shops you've never heard of before? Are these major corporations doing the same strategies that the banks are doing, the wealthy people, the politicians, and now you? So look what it says here. GE, General Electric, publicly traded company. They have to disclose what their executives make for salaries, bonuses, stock options, RSUs, pensions, deferred comp, all that stuff. Here's an interesting note. Second column, retirement savings plan, that's their 401k. How come they're only putting $9,000 in? How come these millionaires are putting $9,000 in their 401k? But Austin, I thought you could put $19,000 in your 401k. I thought if you were over 50, you could put $25,000 in your 401k. Yes. Well, then how come all the executives and the millionaires are only doing $9,000? Well, you see, wealthy people don't put their money in something that they don't receive an immediate benefit from. So this is all they're going to get their match up to. And they're not going to put a dime over what they get their match up to. But my HR lady said I should max it out. But my broke coworker said I should max it out. But my boss said I should max it out. Well, are they rich? Are they millionaires? No. Okay. Well, then don't listen to broke people on how to be rich. Okay. Just a little tip for you. All right. But look at what they're doing with the big money. 445 grand, hundreds of thousands, $300,000. Are you kidding me? Why? Because these people understand they're going to make 6 to 12% rates of return. They're going to grow and access this money tax-free. And when they retire, they're going to walk with all of this money 100% tax-free. So what if we could show you how to bypass the middleman, how to go direct, just like the banks are doing with your money already, but now you earn 6 to 12%, you grow and access your money tax-free, and if you need it back, you take a loan from yourself, not from the bank. Because would you rather pay the bank back a loan or yourself back a loan? Obviously. So this concept is called infinite banking and family banking. And let me ask you a question. Knowing what you know now, do you think it still makes sense to put your money in the bank or where the bank puts their money? Bam. Let's go, baby. Family banking. Let's go. Either be used by the system or use the system. The choice is yours. So one of the articles I love to show people, because you got to understand, people are not going to take your word for things. Like, I know you have a nice smile and you seem trustworthy and you brush your teeth today, right? And you're good. But believe it or not everyone's going to trust you. That's why it's important to be likable, not necessarily only trustworthy. See, it's more important to be likable, to get people to like you, to make a friend, because are we in the financial planning business? No, we're in the people business. So you got to get good with people. But understanding how people work, there's a little bit of skepticism there. They've heard a lot of stuff in their life. They've probably been screwed over a time or two. So you got to understand that there's probably a little bit of skepticism there. That's why you have to have something called third-party validation. You have to be showing books. You have to be showing articles. You have to back up what you say. Something to say, something to show. Something to say, something to show. Something to say, something to show. You guys get it? So what I show is this Forbes magazine. I say, excuse me, don't take my word for it. You can just trust Forbes magazine. I think that's a pretty credible source. Would you agree? Yes. Well, here in Forbes magazine, it talks about how to use life insurance in your retirement planning. Do you know who Jim Harbaugh is? They used to coach Niners out here. Now he coaches University of Michigan. Okay. It says here, investing in the market without taking losses. Is it too good to be true? Not according to University of Michigan's head coach, Jim Harbaugh, who became the top paid college athlete by creating a deferred comp package utilizing, what does that say? Oh, Index Universal Life IUL. Interesting. Interesting. Okay. And look at what it says down here. IULs allow cash value in the policy to grow tax-free over time. And IULs are funded with post-tax dollars, which allows clients to withdraw money tax-free at any age. What? Kind of like what I told you. Okay. What about one of the main advantages of IULs in the market? Wow, I feel like I said that before. An IUL is a cash value policy that has both a death benefit savings portion. The investments are not placed directly in the market where they're subject to a loss. Rather, they are put into a strategy that mirrors the index, such as S&P 500, which allows the participant to realize all or most of the gains in the market. These gains are then, what does that say? Locked in? It's like the index strategy, locked in to protect against potential losses. And in addition, they're much more flexible than an IRA or 401k because there are no restrictions on when the money can be taken out, because the money inside an IUL can be taken out at any age by the client, tax-free and without fees. Say that with me. Tax-free and without fees. One more time. Tax-free and without fees. Doesn't that just sound good, by the way? Man, that sounds good. I love it. All right. So most people are visual learners. Let's get into an actual example, shall we? All right. So let's say you're creating your family bank, okay? You obviously have an IUL chassis that you're going to be utilizing for this family bank. It's going to have some sort of face amount. I meant to lower this down. I didn't want to scare you guys. Let's just call it 500,000, okay? 500,000 on this one. All right. Cash value in your family bank is $50,000, but you have a loan value of 40,000. So what I want to make a note on that you understand is the money in your family bank is determined by your loan value, not your cash value. Please understand, the money in your family bank is determined by your loan value, not your cash value. Okay, I want to be very clear on that. Next thing, let's go through an example. This is an excerpt from that book, Money, Wealth, Life. What Would the Rockefellers Do? It says, when you pay cash for big purchases, the compounding process is interrupted. Put that in your vocabulary. The compounding process is interrupted. Oh, but I have all my money in a 401k. Well, anytime there's a negative, the compounding process is interrupted. Oh, I have a Roth IRA. Well, anytime there's a negative, the compounding process is interrupted. Oh, I just like to save money and then pull from my investments to buy things. Well, the compounding process is interrupted. However, when you pay for those same purchases using your cash flow insurance policy, the compounding process is not interrupted. Why? Because when you take out a loan from your cash flow insurance policy, you are not actually, listen to me, you are not actually taking money out from your policy. You are borrowing against your policy. Let me say that again. You're not taking money from your policy. That would be called a withdrawal. From your policy, you are borrowing money against your policy. Very, very big distinction. Because everyone out there, the lay person out there, thinks about withdrawals. They don't understand how to use all these tax advantages through loan provisions for themselves, their family bank, their favor. So let's go through this again. You have a loan value, family bank, of $40,000. You want to purchase a vehicle that costs $30,000. You can do three things. Number one, traditional financing. You walk down to the dealership, you got no money in your pocket, you take a test drive, you get all emotional, I gotta have it now, right? I gotta have this car right now, okay? And you sign up for $600 a month for 60 months, 5-year plan. That's a pretty standard plan right there at a car dealership, okay? Option number two, you pay cash. You pay cash. Save up, pay cash. Option number three, use your family bank. So let's look at how each of those would work. Number one, traditional financing. What would be the pros of traditional financing? Well, you can get the car right now. You don't have to wait, right? You could give into your little impulse, right? Woo, I got it now, right? Your instant gratification because you have no financial discipline whatsoever. So you can go ahead and get it now, okay? No big upfront investment. Might have to put a little money down, might not. I don't know. It's crazy times. They might let you walk with no money down. I don't know. but you can get it now. Okay? What are the cons? Well, you don't own the vehicle. Oh, I bought a car. No. You took a loan from a bank who owns your car, and you're renting your car for the next 5 years. That's what you're doing. Don't be delusional. You don't own that car. That's not your car. Try missing a few payments and see if it's still your car. No. You don't own the vehicle. Okay? Number two, you're going to pay an additional 20% in compounding interest over 5 years. Why? Well, look down here. $600 a month times 60 months is 36 grand. What did your car cost? 30,000. So you paid 20% more money to go get something now because you had no financial discipline to wait. Number three, you're going to have to fill out some sort of application. You're going to have to qualify debt to income ratio, right? Credit score, all that stuff. You're going to have to apply. You have to qualify for it. Okay. You got to have good credit. Okay. You're going to be on a fixed payment schedule. Some of you don't know what that means. Let me break it down for you. If I want to get rid of this and I go, I have an extra 10 grand, let me throw 10 grand on this car because I want to get rid of it sooner. Your monthly payment doesn't change. Even though now you're only paying on 20 grand of the 30 grand, that's still 600, whether you like it or not. Okay, so you're on a fixed payment schedule. That 600 is not changing for the next 5 years. Unless you pay the car off. Okay, and you get a credit hit if you do miss a payment like that. Okay, so kind of a messy situation. Surprise, surprise, most people do this. Most people do this. Most people are in debt. Most people want instant gratification. Most people have no financial discipline. Most people have bad credit. Most people don't understand how the system works. And so they're in this kind of position all the time. Did you know, believe it or not, you don't have to have a car payment? Did you know that? Like, I'm going to give you permission right now. You don't have to have a car payment. I'm just letting you know. I know everyone else does, but you don't have to have one. I don't know if anyone told you that. So I just felt like I needed to tell you that. Okay. Number two, you can pay with cash. You can pay with cash. So what's the pro? You own it. You actually own the vehicle. You own the asset. You own the thing, right? You own it. You have no outstanding loan. What's the cons? Well, the opportunity cost on the 30K, what you could have earned on that money if it stayed in an account earning interest, but now you put it into a vehicle. So what is that opportunity cost? What did that cost you? And I'm not talking about the 30 grand. I'm talking about besides the 30 grand you used to pay, what else has it costed you to actually do that sort of purchase? Okay. Another con is you got to practice delayed gratification. What if you have no money? You might have to save up for 5 years. You might have to pay yourself a car payment of $600 a month for 5 years and then go buy the car. Okay. Number three, the vehicle will cost more 5 years from now. Have you realized that? Right? It's called inflation. So even as you're saving, you're probably going to have to save more because the car is not going to be the same 30 grand. It's probably going to cost you more than 30 grand 5 years from now. And if you don't earn a high rate of return while you're saving, because you're usually saving in some sort of liquid form, like a savings account earning 0.01%, you're not really going to be making any money as you're saving for that purchase. Family bank. Pro, you own it. Pro, the money still earns market-like returns. The 30 grand that you used is still earning, hear me, still earning market-like returns, still earning the index interest credits as if it never left your account. Very, very powerful. Number three, no application, no qualification. I want my money out of my bank. Okay, sir, put together an application. No. I want my money out of my bank. Okay, where should we send it? That's family banking. I don't have to apply with Honda Financial or B of A or, you know what I mean? Like, no. Like, I want the money. It's my money. Let's go. Do you have to ask when you go take money out of your ATM? No. Okay. No repayment schedule. Well, when do I have to pay it back? Whenever you want. Okay. No debt to income ratio. No credit check. No penalties or credit hits if you miss a payment. Well, I don't know. I don't think I could do it this month. Fine. Don't do it. Really? Yes. It's your bank. It's your family bank. You're making the rules. What's the downside though? Well, if you use the 30 out of the 40 out, You have a decreased availability for your next purchase or investment. So you only have 10,000 unless you put the money back in the bank. You only have 10,000 unless you put the money back in the bank. Okay? Look at what it says here. Taking out loans against your cash flow insurance policy can make opportunity cost work in your favor. It can create positive cash flow that can increase your wealth, all while allowing you to make big purchases. What if it wasn't a car? What if it was a house? What if it was a house and you needed $250,000 to go purchase a house? And you go put the $250,000 in there, and your $250,000 still in your family bank, earning 6 to 12% rates of return, all tax-free, while the house is appreciating. You just double dipped. You just double dipped. You just used $1 twice. You just doubled your asset base. Are you kidding me? Do you see why this is what wealthy people do? Do you see why we teach the middle class what wealthy people do? Like, are you guys excited about this or what? Right? I'm the one teaching it, and I'm like reselling myself the dream. I need to go talk to 10 people today about family banking, right? And changing their financial future forever. That's what we're talking about. How does it work? How does it work though? Austin, I'm a T. I need to know all the, how does it work? Like, teach me all the inner details, right? Okay, all right, here's how it works. You have 500,000 of your policy. You have a cash value of 50. You have a loan value of 40, and you're taking 30 to buy your car. Couple situations. Number one, if you pass away, you never paid it back, then the insurance company goes, all right, you owe us, we owe you, we'll settle up upon your passing. So 470 grand goes to your family. You owe us, we owe you, we'll settle up upon your passing. 470 grand goes to the family. What if you live though? What if you don't die? What if you live? Well, with the power of compounding interest, that 50 grand will more likely become about 80 grand in the next 5 years of compounding interest, okay? And you're going to be paying off the loan from the insurance company. From the insurance company, you're going to be paying back that loan. So how does it work? Well, it works like this. Oh my goodness. Did you guys see that? It works like this. Oh my goodness. One more time. Did you see that? It works like this. Wow. Wow. Do you see how powerful this is? You pay back the loan into your family bank. All the meanwhile, it's still growing. Now the 30 grand's back in there, but you have 80 grand. You don't have your 40 grand that was in there. You got 80 grand now. Is that powerful or what? Wow, look at that. Oh my gosh, that's sexy, right? I love it. So let me teach you guys about this. We just opened up, Eric and Sandra obviously got that $50 million second to die. I'm not in a position to get 50 million yet. Okay, so I had to settle for 10x less, right, with just 5 million, right? But we did a $5 million second to die because as soon as my dad and I talked about this strategy, the first thing I did right when I flew back, because I read the book on the flight back from Hawaii, I called up Eric. I said, Eric, we need to meet. We're having some family meetings and you need to be part of it. Why would Eric need to be part of it? Because Eric's my SMD. Eric's my leader, right? Eric's my mentor. He's the guy I go to for running financial situations through, right? And so I said, I need you to set us up. This is what we're thinking. This is what we're talking. And it was literally all the family, all the Harwoods, and Eric, right? Like an adopted Harwood in there, right? And then guess what? We set up this $5 million second to die family bank. And we put 50 grand in just to get this thing started in our bank, 50 grand, right? We can put 106 in. So I'm looking to max that by the end of the year, but we just put 50 in just to start. By the way, out of all the programs together that we just set up, we put 130,000 and we're getting ready to dump another 100,000 in, right? Another 100,000 in. So we're starting our bank off strong. That's what I'm talking about. I saw a little post by Kevin McGinnis. He said, if you're running a family grocery store, what would your inventory be? Groceries, right? Well, if you're running a family bank, what's your inventory? Money to put in your family bank. That's your inventory. So does it make sense to do the very least in your bank or have the very most in your bank? Obviously, the very most in your bank. So Eric posted this during Money May. He said, congratulations, Austin and Liz Harwood, for starting their own family bank. I now believe that they have the largest policy in Pinnacle. Right? Awesome job. Think bigger. It's Money May. What would the Rockefellers do? What would the Olsons do? What would the Harwoods do? And I love Don Terene down here. Sweet goodness. Go big or go home. Don cracks me up, man. I love that guy. Okay? But you got to walk the talk, guys. You got to walk the talk. If you believe, you'll be believed. If you're convinced, you'll be convincing. Okay? Straight off the website. Here we go. This is me. $5 million. Started on May 12th. How much in my bank? 40 grand. How much in my bank? 40 grand. Put 50 in. I got 40 grand access day one. Day one, my family bank. That's what I'm talking about. I'm not talking about wait until I'm 65 and take this money out and use it for retirement. That's the old school way. That's the old school way. That's like some of you, oh, we got to wait 2 days now before we do your financial review. No. We're in Zoom. This is a new era. This is 2.0. Are you 2.0? Are you version 2.0 of yourself? If you're still thinking the old way, you're going to get left in the dust. All of us are talking about family businesses, family banks, family businesses, family banks. What do? I own a financial agency that teaches people how to set up their family businesses and family banks. Which one of those two are you most interested in, if not both? Boom. Let's go. Let's go, guys. Second half, best half. Second half, best half. Okay? I texted this out to my team the other day. I said, hey, team, I don't just help clients with this stuff. I do it. It's called moral authority. I do it. I'm super convicted about these concepts and products. Are you? Are you, though? Do you want to get better results? Be more convicted. Put your money where your mouth is. And this is a screenshot off my bank account. 50 grand in, 600 in another one, 82, that's one little college plan, 10 grand in another one, right? What does yours look like going into your IULs, by the way? 50, 100, 250, right? What? Your bank? You're putting $100 a month in your bank? Oh my goodness. Oh my goodness. You didn't know what you had your hands on. You just didn't know what you had your hands on, but now you do. Now you do. So you need to get a lot more serious and focused on building up your family bank, your bullet fund, your war chest, your laser fund, your volatility shield, your family bank. You guys get it? Let me show you what happens when you help other people set up family banks. This was one client set up a family bank. How would you like to make 50 grand on one client? This isn't like, oh, this person made 50 grand in a month. No, this person made 50 grand on one deal, one family bank. That's all it takes, guys. How are the Fombos blowing up? How's Levi's blowing up? You want to know why? Because they're not talking about IULs. They're talking about family banks. They're talking about family. They're not talking about joining a company. They're talking about family businesses. It's marketing, guys. It's marketing. The message you're putting out and how it's being received. So we need to get a lot better at the messaging we're putting out so that people can receive it in the best possible manner. Last couple things, additional resources for you, very good books. Hey, if you want to get good at this stuff, you got to master your craft, man. Leaders are readers. I know you hated reading. I hated reading too in high school. You want to know why? Because it was a letter grade. I didn't really want to read for a letter grade, but shoot, to get rich, I'll read for that. To build a business, I'll read for that. To be a better husband or father, I'll read for that. You understand? Leaders are readers. Master your craft. Know how this stuff works. By the way, Jessica Zilker posted in the SMD group me a very technical article, but it basically talks about how it's impossible for an individual investor to create the same strategy and returns that you can get in an IUL. It's impossible because you don't have the leverage that these companies have. So if anyone ever tells you, oh, I do my own investing, I got Robinhood, I got my little whatever, E-Trade, right? Like they're doing it. You can't protect yourself and grow wealth the same way I can in an IUL on your own. You just don't have the power. You don't have the leverage. I'm working with hundreds and hundreds of billions of dollars behind me to back up my strategy. How about you? Oh, you have 100 grand? Oh, tell me how that's going. Come on, guys. Come on now. You got to be convicted about this stuff. If you're more serious, you'll be taken more seriously. But you got to be knowledgeable too. Imagine if we were on a test drive with a car and you're my sales guy or sales lady and we're driving the car and I like it. I like the car. I'm like, man, I like the way this leather steering wheel feels. You know, my heated, cooled seats. I like this. It makes me feel good. I'm luxurious. And then I turn to you and I go, hey, by the way, what does that button do? And then you go, that button? Oh, I don't know. And I go, oh, okay, all right. Well, I mean, it's a new car. It's a new model. How about this one? You go, that one? I don't really know about that one either. Though? And then I go, well, what about this one? You go, no, I don't know that one. When we get back to the dealership, I'll ask someone else. I'll ask my specialist, right? When we get back to my button specialist, right? Come on. You think I'm buying a freaking car from you? That's some of you going out there trying to talk about this stuff. You have no idea what's going on. You have no idea how this stuff works. You're barely convicted about it at all. And you're wondering, how come I'm not getting results? Because you don't even believe what you're saying. That's why. Read the books. Read the family bank strategy. Read the retirement miracle. Speak from a position of confidence and authority instead of a position of fear, doubt, and worry. Can you do me that favor? Can I challenge you guys to do that this second half of the year? I'm willing to bet you're going to get much better results. Okay? I just got a hunch. I don't know. Right? But read up on this stuff, guys. Master your craft. Family banks, family businesses. That's what we're talking about. That's the new era. Not joining a company, not doing financial services part-time on the side, making $2,000 a month. No. Family businesses and family banks. So guys, with that being said, I hope I brought some value to you today. I hope I've shifted your thinking a little bit today. I've gotten you to think a little bit more like a marketing person, like a strategist, like someone who speaks highly about what they do and confidently about what they do, that I've gotten you to think a little better. Who can accept my challenge to go set up a bunch of family banks this month? Who can go set up 5 family banks this month? Who can go set up 10 family banks this month? And don't get it twisted. I'm not talking about a $50 a month college fund. I'm talking about a family bank. I'm talking about 2, 3, 10 grand a month. I'm talking about 100 grand in their family bank, $250,000 in their family bank. That's what I'm talking about. Some of you are your whole lives are about to change if you just implement this stuff right here. Second half, best half. Thank you so much for joining us this morning, guys. Happy 4th of July. Let's go build our family banks and get our own family to financial independence. Thank you so much. Have a great day. God bless.